welcome. Thank you for joining us today for our lunch presentation on the One Big Beautiful Bill, or OBBB, or OB3, whatever you want to call it, whatever acronym or full name you want, that's good. But we want to keep you informed and updated of all these changes. I'm sure we'll be doing multiple of these, so definitely keep an eye out for the webinar invites and updates and recorded sessions that we'll be doing. Thank you for joining us today. We are going to go through what has changed, what has not changed in this bill from both a business and individual standpoint. We will leave time at the end for questions, so stick around for that because I'm sure you're going to have some or learn from what other people have asked about and what we answered. So I'm going to quickly do the housekeeping. I'm Carolyn Powell. I'm the development director here at Tronconi Segura & Associates. Just a couple things for you. If you have questions throughout the presentation, put them in the questions section. We will get them answered either during the presentation or at the end. Utilize that toolbar, it should be on the right-hand side of your screen. At the end of today's presentation, you will automatically receive a survey. Please complete that, give us some feedback if this was helpful, if there's anything you still have questions on, if you would like a meeting with one of our experts, and topics you would like to see in the future. This afternoon, I will be sending you an email with a link to the recorded session, again, our expert bios and the presentation. So if you want to view it again, you can go ahead, or if you want to share it with a colleague that wasn't able to make it today. Also in the toolbar in the handout sections, you can get a copy of today's slides and bios of our experts. So feel free if you want to grab them now in there. So without further ado, and keeping this forward to get to the group information, I want to just go over our presenters today. Lisa Merkel, she is a CPA and partner here at the firm, has been with us for over 10 years and is in our small business department working with clients and individuals. She is also a certified personal financial specialist. David Lever, CPA and partner here at the firm. He's been here over 18 years and he specializes in tax and international tax practice and advisory. Stefan, CPA, principal here at the firm for over 13 years, and he specializes in tax compliance and strategies for businesses and individuals. And he also heads up our government incentives program for the firm. Connor Schaefer, he is an enrolled agent and supervising senior here at the firm. He's been in public accounting for over 15 years, and he specializes in tax, focusing on high net worth individuals and mid-market businesses. So that's my part. We're going to jump right in, and I'm going to hand it over to Lisa to get us started today.
All right, thanks, Carolyn. So as you can see from our topics today, we have a lot to cover. So thank you again for joining us. In a series of marathon Senate and House sessions leading up to the July 4th holiday, Congress passed the Act, formerly known as the One Big Beautiful Bill, or OBBB. The Act makes the 2018 Tax Cuts and Jobs Act tax cuts permanent and provides additional tax relief, including enhanced child tax credits, enhanced standard deductions, and small business deductions. It introduces new tax rates for workers, like no tax on tips, overtime, and also a deduction for auto loan interest for US-made cars. There's also enhancements for families, like expanded child care credits, school choice credits, senior exemptions, and savings accounts for children. So needless to say, a lot to cover today. All right, so the legislation also restores and makes permanent many business provisions, such as full expensing for R&D and capital investments, and enhances opportunity zone incentives. It eliminates certain tax credits, like for commercial EVs and for energy saving home improvements. We'll cover quite a few of those areas today. So we'll start to cover some items for our senior taxpayers, children, families, and many taxpayers in between. I will start by covering just a few general items for individual taxpayers that really affect this entire group overall. So the first of these is the extension and enhancement of reduced individual income tax rates. The rates we've become used to under the TCJA, or Tax Cuts and Jobs Act, that was set to expire at the end of this year will now be permanent. So those include the rates for trust and estates as well. In addition, the income tax range for each bracket will stay at the same levels as we've become accustomed to, even a slight expansion of those brackets. Most of the marriage penalty is eliminated, which was the result when married joint filers end up paying more money than they would as single filers. So this penalty will not be returning, with the exception of those in the top tax bracket. The more favorable long-term capital gains rates and qualified dividend rates of 0, 15, and 20% will stay in effect as well. All right, so we'll move on to the standard deduction. The standard deduction is the basic flat deduction amount based on filing status. Some individuals add to that an additional amount for being 65 and older and for blindness. The standard deduction, if it is higher than the itemized deduction, is taken based on filing status and are between $15,750 and $31,500. The additional amounts are between $1,600 and $4,000 for those 65 and older and for blindness, depending on the individual situation. Alrighty, so we have something new. We have a permanent non-itemizers charitable deduction for individuals. As I mentioned, individual taxpayers reduce their income by either the standard deduction or itemized deductions. For those who do not itemize, starting next year, 2026, there's a new deduction available, which is $1,000 of charitable donations made in cash to public charities and $2,000 for married couples filing jointly. All right, so we also have the extension and enhancement of the increased child tax credit and credit for other dependents, which is extended. The child tax credit, which has been at $2,000 per qualifying child, and $1,400 of which was eligible to be refundable. The enhancements under the new Tax Act permanently increased the child tax credit to $2,200, with $1,700 being refundable. Plus, we have some inflation adjustments that will be applied to those numbers. The Social Security number of the taxpayer and the child must be included on the tax return to claim that credit. So moving on to the credit for other dependents. This is a credit for dependents who don't qualify for the child tax credit, including children age 17 or over, with no children with no Social Security number, and qualified dependents who aren't children, like one's parents or siblings. This credit is $500 for each one of those other dependents, with some income phase outs similar to the child tax credit. So this is going to stay in effect in 2025 and is made permanent. Okay, so moving on to state and local tax limitation, the SALT limitation. Very popular hot button issue in the legislation. SALT is the acronym for state and local taxes, which is the name for the group of state taxes includable as an itemized deduction. And again, just a reminder that if all of your combined itemized deductions are greater than the flat standard deduction amount based on your filing status, then the itemized deductions are subtracted from income to arrive at your taxable income amount. So just a little bit of review there first. So $10,000 has been the most that could be deducted for state taxes, which was the rule under the TCJA. That was $5,000 for those married filing separately. The new act retroactively increases the individual limit or the cap from $10,000 to $40,000 for 2025, and then slightly increases those numbers going through 2029. The act phases out the deduction for taxpayers with modified adjusted gross income greater than $500,000 in 2025, but even after phase outs, the SALT deduction will never drop below $10,000. In 2030, the SALT cap reverts back to the $10,000 level. Okay, so I do see a question that has come in about this. I think I'm going to go ahead and answer it. I'll read it first, and I'll answer it. The question is, okay, so this person lives in California, a high tax state, and they are a W-2 wage earner who earns under the $500,000 cap. They say that they foresee 2025 being a higher income year and being able to deduct $40,000 of state taxes with this new limit and switching from taking the standard deduction to itemizing for 2025. So they probably also have things like charitable donations, some mortgage interest. So now that they can itemize again, what other strategies should they consider for the rest of the year that they can start thinking about now? So this is a great question. We hear this a lot. This brings to mind a technique known as bunching your deductions. which is basically consolidating several years of deductible expenses into a single tax year. This is a strategy that's designed to maximize the tax benefits by itemizing deductions in the bunched year. It's also a good strategy when you find yourself in a higher income year, like this taxpayer presumes they're going to be, going ahead and accelerating deductions into that same year with bunching them so as to mitigate the tax impact a little bit more. So we're certainly happy to help with modeling all of that out if you need a clear picture on what all of that will look like. Some people may also consider a larger charitable deduction in the higher income year, and even utilizing the donor advised fund. So we can help, like I said, model all of that out if need be. All right, so just to briefly continue with some other itemized deduction changes. Prior to the TCJA, we could deduct a limited amount of miscellaneous itemized deductions. Those were tax preparer fees, union dues, unreimbursed business expenses, your safety deposit box fee, and investment management fees. Under the new act, these are still not allowed, but there is one exception, and that is unreimbursed expenses for eligible educators, even coaches. This is going to be for K through 12 teachers, counselors, principals, and aides in a school for at least 900 hours during the school year. This deduction goes into effect after this year. I have not seen a maximum allowable amount mentioned yet in the rules for this, but that could be coming. It's nice to see that the old deduction of $300 that used to be in place finally getting a nice bump, at least for those who itemize. All right, switching gears here to some estate tax matters. This is where we'll get into some basic information on estate taxes, bulk transfers during life or death. I'll be mentioning the estate exclusion or personal exemption amount, which is the amount a person can transfer during life or death without triggering federal estate or gift tax. Had the new act not been made permanent, the higher exclusion amount, it would have reverted back to about $7 million. So the act increased the exemption to $15 million per person, or about $30 million for a married couple when considering what's known as portability, which is a concept meaning that a couple can fully utilize both spouses' exemptions if elected on a timely filed estate tax return. For our New York State guests today, just a reminder that the estate tax threshold in our state is much lower than the federal. It's still at $7 million. So state taxes could be their own webinar. I covered it quickly, but we're happy to help with any estate planning needs you have. So feel free to reach out to us for that and modeling any of those estate tax issues. All right, so moving on to personal exemptions. Again, this is something that we haven't seen since pre-TCJA. Taxpayers were historically allowed to claim a personal exemption deduction for themselves, their spouse, and qualifying dependents. Again, that was suspended during the TCJA period and was set to zero for most taxpayers until after 2025. So the new act has permanently eliminated the personal exemption deduction. This section of the new law also introduces a new temporary deduction specifically for seniors, which Connor is going to cover here momentarily. So I'll pass it over to him here in just a second. So before I do that, I wanted to ensure the audience today that I'm not intentionally leaving out other important topics covered with the new legislation, such as the new Trump accounts, the AMT, casualty losses, the adoption enhancement credit, 529 expense changes. There just simply isn't enough time today to cover all of these. So I do have a spin-off webinar coming soon, probably in the next week or so, that will cover these topics in more depth, along with Nicole Overcamp from Wilcox Financial Planning. So this is going to be part 2 in our series. Our first part was about a month ago before the act was passed. So you'll see the link to this soon, and that's going to be a conversation with her to cover how these different aspects of the act impact financial planning for the rest of 2025. Some smart money moves to make now, so you won't want to miss that. So Connor, I'll pass it off to you.
All right, thank you, Lisa. So starting off here with something that Lisa just briefly mentioned, the senior deduction. So it utilizes the same code section as the old personal exemptions, which back before Tax Cuts and Jobs Act, we're just hovering around $4,000 a person. The new deduction available specifically for seniors, in this case, people who are 65 or older, is going to be $6,000 per taxpayer. So that is going to wind up phasing out. So at the upper income levels, you're not going to be eligible for this deduction. It winds up shaking out that for, every $100, you lose $6 worth of the deduction. So if you're a single person making $175,000 a year, the deduction goes away. If you're a married couple at $200,000 a year, the deduction goes away. For one of you at $200,000, it goes away for both of you. So in order to be eligible for this one, you cannot file a separate return. So married filing separate individuals are not entitled to this deduction. So the next one, and this one is one that a lot of people have been talking about. It's been floated, I think, a couple times throughout the years. It's finally seemingly made it into law. A car loan interest deduction. So a bunch of stipulations on this one, but at the end of the day, the important ones are this. So primarily, the big thing is that the final assembly of the vehicle must occur within the United States. The definition of final assembly is, as with all tax law, annoyingly vague. However, we've been promised that the IRS and Treasury will be coming up with, a list of acceptable vehicles, similar to the way that they did for the electric cars and that sort of thing, where you could go in and look up what was eligible and what was not. It has to be a new car, cannot be a used car, has to be a personal use vehicle. So businesses who are already, eligible to deduct, their car loan interest if they were financing their vehicles, no change. This is a personal change only. Anything that was acquired prior to 12/31/24 generally isn't going to be inherently eligible unless you refinance that debt. The refinancing of the debt, at the end of the day, it's kind of limited in scope as well. The car still has to qualify, and it also has to be secured by a first lien on the vehicle. So generally what that's going to mean is that I can't go and refinance with a different lender because that's going to be a new lien on the car. I'm going to have to refinance with my current lender, and I'm also not allowed to refinance for any more than the amount of the debt that existed immediately prior to refinancing. So if let's say, the car is worth $11,000, but I only owed $10,000 on it before, I can't go and cash out the extra $1,000 and still qualify for this deduction. In general, it needs to be a minivan, an SUV, or anything that we would normally describe as a car. Things like motorhomes and that sort of thing are not going to be eligible. The gross vehicle weight rating needs to be beneath 14,000 pounds, which is pretty big. So most trucks and that sort of thing will qualify. And related party sales will also not qualify. This is an above the line deduction, so it's available to people who are itemizing or not itemizing. And it's going to be calculated in between adjusted gross income and taxable income, kind of like the qualified business income deduction is right now. So the only other quick things on this is there's going to be some reporting that's required to happen on the 1040. You're going to have to report your VIN. We don't know specifically how that's going to happen yet. My guess is there's going to be a separate form, or there may be an additional line item, on the face of the 1040 that will support the deduction. In general as well, provided that you are paying more than $600 worth of eligible interest, your bank or your lender is now going to be obligated to provide you with some sort of new informational reporting form if they've received more than $600. So the same way currently that you get a 1098 for a student loan interest or a mortgage payment or something like that, we're also expecting, my guess is, something in the Form 1098 series that will provide you with this interest information as well. So the next one, and this was, pretty heavily talked about throughout, the campaign season, is an overtime pay deduction. So it's not unlimited in scope, but it is going to be beneficial, for some of the lower and middle class taxpayers. So generally, your AGI limitations, your modified adjusted gross income limitations for this are going to be if you're making south of $150,000 or south of $300,000, depending on your filing status. It only applies to overtime that is required to be paid under the Fair Labor Standards Act. So if you're an exempt employee and let's say your company pays you, a straight time overtime rate or time and a half overtime rate, beyond what you'd normally get paid, but they're not required to pay that to you. This does not qualify for that deduction. Only overtime required to be paid under FLSA is required to, is allowed to be deducted. Doesn't include tips. So if I'm, a server or, a barista or something like that, where I'm working overtime, the overtime hours that I get, the pay that I receive, eligible for deduction. The tips are not, but that's only because they're going to be covered under a tips deduction, which we'll talk about shortly. So same as the car loan interest deduction, this is going to be an above the line deduction as well. It's going to be capped at $12,500 or $25,000, depending on filing status. And it's important to note this is income tax only. So even though this is relating to wage, this does not reduce your liability for Social Security or Medicare taxes. What's going to happen is your wages will still be reported on your W-2 at gross. There will wind up being a new box on the W-2 for both the taxpayer and the IRS to receive the information that says how much of the eligible overtime that you receive for the year can go towards this deduction. Withholding tables are going to be revised according to the law. They're prescribing that on Treasury. So you won't wind up seeing a big change in a refund on the return. If you're overtime heavy, you're just going to get that money up front because your withholdings will be adjusted. The next one is no tax on tips. This was also a big one from the campaign trail. The modified adjusted gross income limits here, same thing, 150 and 350. It's available, and this is important here too, to both self-employed and wage earner individuals. Now the catch is going to be here. We're not going to be able to see people who are going to say, oh, I'm going to start getting paid in tips. So as part of this law, the Congress has said that the Treasury Department and IRS need to come up with a list of professions where prior to the end of 2024, it was customary and regular that the employees or self-employed people were receiving tips to begin with. So, the common examples we can all think of, let's say your barber, your nail tech, bartender, barista, server, that kind of thing, all the things we normally expect. That deduction is also going to be above the line. It is also income tax only. It's not FICA. So it's going to be reported kind of similarly to how we would see Social Security tips right now on a W-2. We're just going to see a separate line item. It might not be, kind of equal to, your wage box. That reporting is to be determined. There will be new W-2 reporting requirements prescribed by IRS. Same thing, the withholding tables will be adjusted. And a big thing to note is here, if I'm a self-employed person receiving tips as part of my self-employment, the definition of QBI will not include your tips received. So you won't be able to factor tips into, or tips that are eligible to be deducted in your QBI calculation. Okay. So the last one here that I am going to talk about briefly is some energy related provisions. Now, same as something that Lisa had mentioned earlier, there are other things that I'm not going to be talking about related to the energy provisions. There's items on, there's new items on nuclear, there's new items and restrictions on solar and wind. Those are going to be beyond the scope of this webinar, but feel free to reach out and ask questions if you have any. In general, easy thought process when it comes to this bill is if you knew about it before and it related to clean or green energy, it probably doesn't exist anymore or it's being terminated early. There are new provisions that are coming in that are beyond the scope. Like I said, the big ones, clean vehicle credits are generally going away after 9/30/2025. Bonus depreciation on solar and wind property that got specifically roped in under 168 several years ago as part of the definition of qualifying property. That is actually retroactively gone. So if you placed anything in service that is considered solar and wind property that previously would have been eligible for bonus, after 12/31/24, we no longer get the benefit of that accelerated depreciation. Energy efficient home improvement credits, residential clean energy credits, which a lot of us have utilized previously. They weren't huge, right? But we all saw people, maybe even ourselves, with them every year. Those are good through the end of the year, and then they go away. So those are gone, and unfortunately, they're probably not coming back anytime soon. Now I think we're going to pass it over to Stefan, who's going to discuss our business provisions.
Thank you, Connor. Yep, I'm going to be covering the major business provisions of the OB3. First up, I'm going to talk about the bonus depreciation. So under previous law, bonus depreciation was set to sunset by 2027. It was going to be 40% in 2025, 20% in 26, and 0% in 27 going forward. Under the new bill, it makes 100% bonus depreciation permanent for eligible property acquired after January 19th, 2025. Eligibility criteria otherwise is the same as current law. You must have a written binding contract in place for determining the acquisition date of all eligible equipment. And there is a special election available for reduced bonus depreciation rates for property acquired after January 19th, 2025. Piggybacking on bonus depreciation, there is a new provision in the bill which establishes qualified production property. So the IRC section 168 is amended to provide a 100% special depreciation allowance election for non-residential real property used by the taxpayer and an integral part of a qualified production activity. Qualified production is defined as the manufacturing, production, or refining of a qualified product. QPP does not include space for non-manufacturing, non-production, or non-refining activities. Some examples of these are for office space, for space used for sales, for R&D activities, and for engineering activities. For bonus depreciation purposes, QPP constitutes its own separate class of property. The QPP must be placed in service in the United States or any possession thereof, and original use must commence with the taxpayer. Used QPP does not qualify for 100% treatment. Construction for this property must begin after January 19th, 2025, and before January 1st, 2029, and the property must be placed in service before January 1, 2031. The provision applies to otherwise qualifying property placed in service after July 4th, 2025. QPP is subject to special depreciation recapture rules on disposition. Next, there is an increase in the section 179 expensing, beginning with calendar year 25. The base deduction is increased from $1 million to $2.5 million, and the asset limitation phase out is increased from 2.5 million of assets placed in service to 4 million of assets placed in service. So a nice benefit to taxpayers. Next, I'm going to touch upon the section 163J interest limitation changes and the calculation of adjusted taxable income. The legislation permanently modifies the calculation of ATI for the purposes of the business interest deduction. Specifically, the bill reinstates the initial TCJA calculation of ATI, which puts it on an EBITDA basis rather than an EBIT basis. This allows for a widened deduction base. Floor plan financing is going to be extended to certain trailers and campers. The amendments and changes to IRC section 163J apply to taxable years beginning after December 31, 2024. There will be a new interest capitalization coordination rule that applies section 163J limitations before elective interest capitalization provisions. And this is effective for tax years beginning after December 31, 2025. Next, there is a slight change to the deductibility of employer-provided meals. Employer-provided meals are currently fully deductible by the employer, and employees may exclude these from gross income. However, beginning in tax years after December 31, 25, business expense deductions are now disallowed for employer-provided meals that are excluded from employees' gross income or are considered de minimis fringe benefits. These meals will now need to be tracked more carefully. Next is one of the biggest changes in the tax bill, and this is the treatment of domestic R&E or research and experimental expenditures. The new bill makes current deductibility of domestic R&E expenditures permanent under new IRC Section 174 Cap A for amounts paid or incurred in tax years beginning after December 31st, 2024. Alternatively, taxpayers may make an irrevocable election for current and all subsequent tax years to capitalize domestic R&E expenditures and amortize the amount ratably over a period of not less than 60 months, beginning with the month in which the taxpayer first realizes benefits from these expenditures. Certain transition rules do apply. Certain small businesses may elect for retroactive application of the expensing rule to apply to tax years beginning after December 31st, 2021. Non-qualifying small business taxpayers may deduct previously capitalized and unamortized domestic R&E expenditures over a 1 or 2 year period, starting in the first tax year after December 31st, 2024. Rules to coordinate the current deductibility of R&E expenditures with the research credit are also provided. There is, however, no change to how foreign R&E expenditures are treated. These expenditures are still capitalized and amortized over 15 years. No change from prior law. Next, I'll touch upon the pass-through entity tax. As Lisa previously noted, the individual salt cap has been raised to $40,000, and that reverts back to $10,000 in 2029. In response to the initial salt cap decrease to $10,000, many states adopted what are called pass-through entity tax regimes, whereby the taxpayer, the pass-through entity would pay state income taxes at the entity level, with the owners of the business receiving a credit against their state taxes. This allowed owners to avoid the $10,000 cap on state and local taxes at the individual level. The final legislation in the OBBB does not shut down the pass-through entity tax workaround. The legislation continues to permit a pass-through entity to deduct salt taxes at the entity level, reducing the income allocated to its owners and effectively circumventing the salt cap. Next up, there are some changes to charitable contribution limits made by C Corps. IRC Section 170 was amended to limit the ability of C Corps to deduct charitable contributions for tax years beginning after December 31st, 2025. A C Corp's deduction for charitable gifts is allowed only to the extent that the aggregate of the contributions both A, exceeds 1% of the corporation's taxable income for the taxable year, and B, does not exceed 10% of the taxpayer's taxable income for the taxable year. There are some slight changes to opportunity zones. Opportunity zones currently designated under the TCJA remain in effect through December 31st, 28, allowing for investors to defer and potentially exclude capital gains by investing in qualified opportunity funds that support development in low-income communities. The new act establishes permanent opportunity zone policy, creating a rolling 10-year opportunity zone designation beginning in 27. The act also maintains opportunity zone designation processes and strengthens eligibility requirements. Next, there are some changes to Section 1202 qualified small business stock. For stock issued after the enactment date of the bill, July 4th, 2025, the new law creates a tiered exclusion structure. A 50% exclusion from gain from qualified business stock is available after 3 years, 75% after 4-year holding, and 100% after 5-year holding. The $50 million limit for gross tax assets of the issuing corporation increases to $75 million for stock issued after the date of enactment. The $10 million cumulative limitation also increases to $15 million. Next, the tip credit is extended to include beauty service businesses. For tax years beginning after December 31st, 24, the tip credit will apply to tips received from customers or clients in connection with providing barbering, hair care, nail care, aesthetics, and body and spa treatment services, if the tipping of individuals providing such services is customary. Certain reporting requirements will apply. This applies both to the payee and to the IRS. no wage deduction will be allowed to the extent that this credit is claimed. And finally, there will be some changes to 1099 reporting. For Form 1099-K reporting, the recent revision to de minimis rules for third-party network transactions has been repealed. The de minimis rule retroactively remains defined as transactions exceeding $20,000 and an aggregate number of transactions exceeding 200. And finally, the Form 1099 reporting floor is increased from 600 to 2,000 for payments made after 2025. And this will be indexed for inflation after 26. And with that, I'm going to turn it over to David Lover.
All right, I'm going to jump in before we get into the international piece, because we do have a couple questions that came in, so I just want to get these answered. Diana had a question, parking lot resurfacing and restriping, does that qualify for bonus depreciation? Anybody want to grab that one for Diane?
Yeah, I'll take that one. Yes, these should qualify as land improvements capitalized over 15 years, but they should be eligible for 100% bonus depreciation as long as they're placed in service by the right date.
Great, okay, hopefully that answered it for you, Diane. Let us know if you have more questions on this. Connor, I think this next one's for you. For home solar, does eligibility depend on the place in service date, the payment date, or something else?
Yep. In general, for most of the stuff, and I think we're probably specifically asking in the event of ones that are expiring, it's going to be a placed in service date. Not to say that IRS might not come back and ask you why the placed in service date and the payment dates are in two different tax periods, but in general, it's going to be the placed in service date. So as long as it's placed in service before then, you should be fine.
Great, thank you. And this one, I'm assuming, is either coming back to Stefan or Lisa. My understanding of deductible meals is that if meals are purchased at fair value, they are still deductible under OBBB. Does that sound accurate?
I believe that is accurate, yes.
Okay, so we think that is good, Cody. If you have any further questions, just pop them in here. Before I turn it over to David, if anybody has questions, again, put them into the questions part on your toolbar to the right. Otherwise, I'm turning it over to David. Thank you.
Thank you, Carolyn. All right, well, I'll bring home with everybody's favorite area, which is international tax provisions. So what's important about what's in here is there we go. Perfect. Sorry, technical difficulty. So in the international area, it's important to note just so much as it's important as to what's in the bill as to what's not in the bill. Leading up to the bill, there's this highly controversial Section 899 retaliatory tax on companies or countries that were levying additional taxes, unfair quote unquote taxes on US businesses, including digital service taxes and minimum taxes under the OECD Pillar 2 provisions. As part of the House bill that was passed, a 5% surcharge annually was included on withholding rates that would be applicable to things like dividends, interest, rents, and royalties for non-resident investors in the US. This was not included in the Senate bill, and it was removed and effectively was used as a negotiating tactic or ploy in part of non-tax trade negotiations. So for the time being, that is still on our radar in terms of a possibility in the future, but at this point in time, did not make it into the bill. So the next couple of slides, we're just going to go over some of the changes to the popular FDII and GILTI tax regimes. I always think of these as inversions of each other. The FDII regime is an export incentive that's available to corporations, C corporations only for their exports of products that leave the US. And then the fame named GILTI tax, Global Intangible Low Tax Income, is effectively what I refer to as a minimum tax on foreign subsidiaries of US businesses that are operating in low tax jurisdictions. So under the tax law changes on the GILTI tax, we're going to talk about the change in the calculation. So no longer are we going to be addressing this 10% deemed return on tangible assets. So no longer really is the goal of the bill or of the law more so to tax just the intangibles. It's really looking at attempting to tax profits that are being offshored to low tax jurisdictions. So that's going to result in some changes to the monikers and acronyms here. So going forward, we're going to refer to this as foreign source net CFC, being a controlled foreign corporation tested income. And you may recall that this tax really applies to what we call controlled foreign corporations. So you have to have 50% or more of US ownership of a foreign entity in order to be subject to the GILTI tax. In addition to that, your piece of it has to be at least 10%. And so within that computation as well, there's going to be some changes to the deductions. We have this section 250 deduction, which is a 50% reduction of your income. That's going to change to 40% under the tax law change. And then we're still going to continue to allocate directly allocable expenses, and this more falls under the foreign tax credits available under the GILTI regime, but no longer will we have to allocate R&D and interest to that foreign source income under the foreign tax credit allocation. So it should allow for more foreign taxes to be creditable against the GILTI tax. And then the last item on this slide being the deemed tax paid. So again, corporations that are subject to the GILTI tax, they are eligible for currently an 80% credit for taxes paid by the entity in that jurisdiction. That is going to change to 90% beginning in 2026. And then again, the change in the deduction rate to 40%. And I think I've covered a couple of these items already as well, but these also affect the inverse, which is the FDII deduction. So no longer will we refer to FDII as FDII, but we'll refer to it as foreign derived deduction eligible income, because no longer will the intangible piece be a part of it. So we'll no longer be subject to effectively a haircut for a tangible deemed return on our assets being used to send product abroad. But at the same time, there are some rate changes as well noted here at the bottom of the slide that will change the deduction percentage from effectively 13 1/8%, which was the effective GILTI rate, but also the effective FDII. So they're kind of an inverse of each other, down to what amounts to a 14% rate. Under the TCJA, that was supposed to dramatically increase to almost 16.5% beginning in 2026. So the effective rate for that was brought back down. And then moving on to another great acronym, BEAT, the base erosion tax that's applicable to corporations that have $500 million or more in annual gross receipts. And again, this is a limit on the amount of payments that can be made between related entities to effectively erode the tax base in the U.S. For payments that for things like management fees and other charges between commonly controlled enterprises. Here we just have a rate increase, not as high as it's supposed to be under the expiring TCJA. So it only went from 10 to 10.5% as opposed to a jump to 12.5% beginning of 2026. And then also in the vein of control foreign corporations, we have some slight rule changes that and this provision will more or less affect transactions between the foreign subsidiaries. So under TCJA, whoever owned the entity at the end of the year would be subject to things like guilty and subpart F income, was referred to as the last day rule. So this often came into play in transactions because they had to be accounted for, where there may be a tax liability that, although it's being earned by a seller in a transaction, the buyer would have to absorb that as a cost of the transaction. And so the OB3 changed that. So now control for corporation ownership will be deemed on any day of the year, and there would be a pro rata allocation of those tax items going forward. And then finally moving on to this one, I left a little time for this one because this one's a little bit more difficult, I think, for all of us to comprehend. So we have this concept of downward attribution, and this is something that was implemented by TCGA, then quickly repealed, but now it's being reinstated under the OB3. So in this example, where I have the small org chart here at the bottom of the slide, we've got a foreign company H that owns a U.S. subsidiary Z, and it owns 51% of it. And in addition, FCH also owns another foreign subsidiary W that operates in a different jurisdiction. So under this downward attribution rules, the USZ entity will look upstream to FCH and then back down to FCW and deem to be have control of FCW. So this is important for purposes of considering, we have a new concept called foreign controlled foreign corporation. So this will be important for reporting. USZ may have to report a Form 5471. In this situation, USZ would not receive a allocation of any subpart F or guilty income because it does not own a direct ownership, so it would just have a filing requirement. But at the same time, if for some reason USZ had its own direct ownership in FCW, even if it was a minority ownership, it would receive both a direct and indirect allocation and could be considered to be a CFC in the more traditional sense. So, this is a simple example. I think there are other org charts and company structures that may be more complicated to this. If you have more minority owners, either, like, for example, an FCH, that might be US, where this could get more complicated. So what it's really just going to require us to do is to kind of re-examine our structures to make sure that that we aren't unwittingly or unknowingly subjecting a U.S. subsidiary now to additional subpart F or guilty inclusions, and at the same time, probably an opportunity to restructure those as available. And that is all I have for the international piece.
All right, thank you, my experts on this. This was a lot to go over and talk about, a lot to digest. If you have any questions, again, please pop them into our question section and we'll get those answered for you. And like I mentioned earlier, you will get a survey at the end of this that, again, you can ask questions. You can ask to meet with one of our experts, and I will send you an email later today with a copy of the recorded session and the presentation. So feel free to keep an eye out for those and get back to me on it. David, looks like an international question came in for you.
Yeah, looks like a couple here. So the first is, can the retaliatory tax be imposed by executive order? I think that's referring to my first slide, which was the 899 tax. Because it is an income tax, and the 899 section was supposed to be a statutory override to tax treaties, I believe that would have to be something that was passed by legislation. So I know it's been being used as a negotiating tactic, and I know it was long sought after by the Republicans, I believe, as a way to repeal some of the other taxes being assessed on US companies abroad. I believe it has to be brought up and passed by Congress. I don't believe it could be imposed by executive order, but it's something that we're going to continue to monitor. And then the second question was about tariffs. Were there any changes to tariffs in the OBBB legislation? Again, this was a tax bill, so not really impacting trade tariffs, that type of thing. Not to my knowledge.
Okay, great. Thank you for answering those. I want to thank everybody for joining us today. If you have any questions, reach out to our experts. All their contact information is here. We will also be sending more updates as we get them and doing more presentations and recordings as needed. So thank you again and have a great afternoon, everyone. Thank you.